All right. Good morning, everybody. Welcome to Pull More Profit from Your Real Estate Business. Appreciate everybody being on. Keep in mind, if you are watching from Facebook, you can always drop comments in. We do monitor there. Also with StreamYard here, we'll be monitoring comments. So want to start off today by talking about how we can start generating and pulling more profit from our business. Have you ever Think about this for a moment. Have you ever had a year where you feel like it was a great year? You did fantastic. Maybe you just recently got your 1099 and you saw how much you made, and then you looked at your account, your bank account or bank accounts, and said, where did it all go? All right, who's ever had that feeling where it's like, hey, I had a fantastic year, I made a bunch of money, and where did it all go? So what we're going to talk about today is how we can start pulling more profit from our business and how we can do this effectively every single time we get a commission check, every single time we make money, every single time a dollar comes in, what we can do systematically to make sure we're pulling more profit from our business. Now, here's the reality of the situation. The reality is 80% of small businesses break even or lose money. That means 8 out of 10 businesses, and you are a business owner as a realtor, but 8 out of 10 businesses go to work every day. They work hard. They provide a value or service to a consumer, and 8 out of 10 of them break even, or they're actually paying to do that good or like to provide that service. They are paying money to work in that job. And so the challenge I see there is for a lot of us, we don't know, our expenses get out of control. We have income coming in, money's coming in, money's going out. And because of that, 80%. Now think about that. Maybe you fall into that category right now and you want to be out of that category. Maybe you've got everything dialed in, you're making profit, you're looking to just increase a little bit more profit. And that's cool. We're going to talk about all of that today. See, in our industry, especially in the real estate industry, it's super easy to get caught up in the awards of the sales volume and units and GCI, gross commission income. And it's easy to get distracted by that. That's one of the biggest negatives, in my opinion, in our industry is we get rewarded by the number of homes we sell, by the volume we sell, by the gross commission we bring in, and we don't get rewarded by profit. And so it's easy to get away from what's really important. People will spend and spend and spend and spend to become the number one agent. And when in reality, then at the end of the day, there's not a lot left. We've all heard the story of the successful realtor that got the award on stage for the number one realtor and then broke down and started crying because her house was going into foreclosure. It's easy to get caught up in this trap of, if I just spend a little bit more, I can buy this and then I'll get my sales up. But at the end of the day, it's about how much are we taking home. You would be amazed at how many people, there are agents out there running $100 million sales team that were more profitable when they were a solo agent making selling $3 million in sales. Now, I know that seems crazy because the difference in income, 100 million, 2.5 to $3 million or 3 million in commissions, as opposed to a $3 million, maybe we're somewhere between $80 and $100,000. You would be amazed though, with sales teams, how quickly expenses can get out of control and profit can get cut to nothing. And so what we want to talk about today is how do we get our business really rolling, and how do we put a system in place to generate more profit and pull more profit from our business, so at the end of the day we're making more and we're keeping more in our pocket, not just spending more saying we're investing it in our business, because that's the trap I see too. For a lot of us, it's easy to just spend more and say we're reinvesting that into our business, but are we really reinvesting it, or are we just spending money? Are we really gauging how much of a return we're getting on that investment we're making in our business? Or is it because we're bored, in what's working in our business? Because sometimes success is very boring. And are we getting bored with what we're doing, even though it's working, and we're thinking, well, let me go invest in this shiny new object. And at the end of the day, is it generating the return we need? And if it's not, we need to get rid of that. But again, it's not about how much we make, it's about how much we keep. So here is the biggest challenge I see with the traditional accounting method. Now, a lot of these principles I'm going to talk about today, they came from a book I read years ago called Profit First by Michael Vakarowitz. Profit First. If you haven't read it, check it out. So I do things just a slight bit different than he teaches in the book. But I read the book, I think 5 years ago now, maybe more. And I started implementing this into my business, and I promise you it does work. This is something I utilize in my businesses. It's something that does work. Leo just dropped the link. Thank you, Leo. He just dropped the link there for the book if you'd like to buy it. But everything I teach is stuff I'm actually doing as well. I think that's important to realize too. It's not stuff that I just read and I thought, oh, this sounds good, let me go teach on it. Anything I teach on are things that I'm actively doing or have done in the past that have worked well for me. I think that's just an important little disclaimer to put out there. This is not stuff that I just learn and I say in theory, I think it'll work. It's stuff I actually do. I only teach stuff that I do, that I'm currently doing, or that I have done. So the traditional accounting method is sales or revenue come in. We go sell a house, money comes in, we pay our expenses, and then we live on what's left, which is our profit. So the challenge with the traditional model, this is the generally accepted accounting practice. The challenge with this is that generally when we have more sales come in and more money coming in, our expenses go up. If we have $100,000 sitting in a checking account, we start to feel a little bit comfortable. We start to feel like, oh, I've got a lot of money in there. And it's easier to go be a little bit more cavalier with spending that money. So it's the same way in good markets. You see real estate companies take on debt, they spend more, expenses get out of control, they hire more people than maybe than they need. And then when the market turns and shifts into a different market, you start seeing layoffs happen, you start seeing massive pay cuts, you start seeing massive expense cuts. People never anticipate, in corporations as well, when times are good, it's rare they anticipate that things will change. And that's the one thing for my 20 years of doing this now. I know the market changes often. Things change. If we're riding a high on a fantastic market, seller's market, put the house on the market, 20 offers, 50,000 over asking, no inspections, no appraisals, super easy if you're a listing agent to make money, it will change. And we've seen that happen. So the market will change. And so with the traditional accounting method, what I don't like about it is we're paying all of our expenses and then living on what's left. And it's easy to increase expense when money is coming in. Oh, I'm making 40 grand this month. I can go spend more money on this. Oh, I just made a $50,000 commission. I can go blow it on this. It's easy to spend money when it's coming in. And so what tends to happen with that is we get what's called expense creep. Who's had this happen? We get, all of a sudden, we're like, oh yeah, that $199 a month expense, it's only $199 a month. You start spending it. It doesn't generate your return. 12 years later, you're still paying for it. But in addition to that, you've taken on 4 or 5 other expenses that you said, oh, it's only $79 a month. Oh, it's only $49 a month. Oh, it's only this. And all of a sudden now you've got $1,000 plus or more in expense on stuff that you're not using and that's not generating your return. And that's what we call expense creep. So if you find yourself saying it's only this, only $99 a month, I would stop saying that. I would stop saying it's only and look at it and say, rather than saying it's only $99 a month, I need to start looking at it and saying it's $99 a month. That is roughly $1,200 a year that could be tied to profit in my pocket. Is this a necessary expense? And I would start looking at money a little bit differently. You know, I used to look at it in the past. It's only this. Oh, it's only this. If I just close one house, it pays for itself. Oh, it's only this. It's only this. When I started to respect money more is when I started to make more money and keep more money. And so if you find yourself saying it's only, I would stop and look at everything you do from an investment standpoint, not just spending money for the sake of spending money. Now, this is our traditional method of accounting. So here's a couple of things before we get into what I think is the better route to go. We need to think about as a new agent, oftentimes when we first got into the real estate business, we probably had all of our commissions going into our personal checking accounts. Who had that? I know I did. Money dumped into my personal checking account. It was a mess, right? It was flooded in with all my other personal expenses. I had no idea how much money I made. I had no idea how much money I was spending on my business. I was operating out of a personal checking account. So if we're doing that currently, one thing we need to do is set up a business checking account, and we need to differentiate our funds. We need to differentiate our business income from our personal checking account, which means we also should have a profit and loss statement. We need to know how much is coming in, how much is going out, how much net profit we're actually making in our business. So if we're not working off a P&L, that's something we need to start doing as well. Now, here is the profit first accounting method. So the profit first accounting method is essentially our sale. We go out and sell a home. We make our compensation, our revenue. We pull our profit from that first, and then we pay our expenses with what's left over. So I know that seems a little strange, and let's just talk through it. $10,000 commission check comes in. I pull out my profit that I want, and I pay my expenses with what is left over. Now, seems simple, a little bit more difficult. We're going to dive in and explain it. My dad used to tell me when I was in my 20s, he used to tell me, pay yourself first. He would say, pay yourself first. And I didn't understand that because I would say, well, I don't have enough money to pay myself. And what he meant by pay yourself first was I need to pull out money, put it into my savings or my investment, and then live on what's left over. And I would say, and I would think, and I guess I never really talked to him. I would just listen to him and then just immediately say, well, pay yourself first. I don't have any money left. I'm broke. I'm constantly broke every month after I pay my bills. And here was the challenge though. Like, could I back then have saved $100 a month? The answer is yes, because I always found money to go do things that were important to me, like go out to an event with my friends, or go on a weekend vacation with friends, or go to a baseball game, or whatever the case may be. I found money to do things that were fun. I wasn't disciplined though to save. So I would justify and say, well, I don't have enough money to pay myself first. I did. I just wasn't disciplined to put that money into a savings. I'd rather spend it on something that was enjoyable for the moment. And so with this model, what we're doing is paying ourselves first. Now, let's dive in and talk about what that looks like. So first thing we need to think about is how much profit do we want our business to generate? What is our profit? How much do we want it to generate? Do we have a set target for how much profit we want our business to generate us every month, every year? And if not, let's start thinking about that. If I make $100,000 a year in income, how much profit do I want that to be? How much do I want that to be in profit? What percentage? Now, with the profit first model, here's what it is. We need 4 bank accounts. So the Profit First book will tell you need 5. I found that 4 works very well. 4 accounts you need. Now, I know what you're thinking right now. You're probably like, my gosh, it's hard enough just to have 1 bank account. Now I need 4. And if I have multiple businesses, I need 4 for separate businesses. So if I have 2 businesses, now I need 8 accounts plus my personal accounts. Now I'm up to 10 with savings, maybe 11, 12, maybe 14. Maybe I have 20 accounts now. But yeah, 4 accounts for each business. So for your real estate business, you need 4 accounts. Here's what those accounts are going to be. They're going to be an operating account. We call it OPEX, right? OPEX, operating account, an owner's compensation account, a tax account, and a profit account. So what you would want to do, if you're taking notes, is you want to write these down or take a screenshot. You want to go to your bank, and it's going to make more sense once we get into this a little bit more. But you would want to go to your bank and set up 4 checking accounts. 4 checking accounts for your real estate business. And then you're going to name each one: operating account, owner's compensation account, tax account, and profit account. So what you want to do now is you have your 4 accounts set up. And now what we need to do is we need to talk about how much profit how much money we need to allocate to each of these accounts. So again, this might be confusing, but I hope at the end it's all going to make sense, and we'll take questions too. Now, my operating account. What is my operating account? My operating account is where all of my commission checks flow into. So if I go out and sell a house and I get a $10,000 commission check, that check gets paid, that commission gets paid into my operating account. So now that operating account has $10,000 in it. Now, this is also the account I'm paying my expenses from. So if let's say I do some form of lead generation, I'm paying for an expired listing service, and that's $99 a month. That's getting paid out of my operating account. If I rent an office space, that's getting paid out of my operating account. If I, copies, marketing, signage, all of that stuff, all of my expenses to run my business are coming out of my operating account. So my $10,000 commission check, for example's sake, gets dumped into my operating account. And then the other accounts I need set up are my owner's compensation account, What the owner's compensation account is that this is how much I'm paying myself to run my business. So a simple way to think about this now, for a new agent, you might be thinking, well, I'm paying myself all of it. Right? Like I'm paying myself all of it. And so what will happen though over time as you increase your revenue and your revenues increase, you will begin to, your accountant will most likely tell you they're probably going to have to put yourself on salary and then also do what's called profit distributions, which we'll talk about here in a moment. So owner's compensation, and the easiest way I found to figure out how much you should pay yourself to run your business would be if you had to pay someone to step in and operate your business and you stepped out of it, how much would you pay them? And whatever that number is, that's the number you should start paying yourself. Now, owner's compensation, if we're making $50,000 a year, this is a little bit tougher to do, right? Because there's not a whole lot to pay yourself from an owner's comp perspective. When we start hitting north of six figures, 100,000, 200,000, 250, 500, a million, this makes a lot more sense. These numbers will begin to make a lot more sense. Now, so owner's compensation. So I have an operating account. I have an owner's compensation account. The next account I have is a profit account. So profit account is the amount of money I want to put in there that I'm going to pay myself in the form of a profit distribution. Now, why would I want to pay myself an owner's compensation, and then separately pay myself a profit and from a profit account in the form of a profit distribution? The reason for that is because the IRS will tax you less on a profit distribution than they will on wages. So if I'm paying myself, I have to pay myself a honest wage through owner's compensation, but then I'm bonusing myself through a profit distribution monthly that is getting taxed at a lesser rate than my normal income. So my profit account is my third account, and my fourth and final account is a tax account. So my tax account is where my tax money is going that I'm setting aside to pay my taxes at the beginning of each year when the tax bill is due. So 4 accounts: owner's compensation, profit distribution, operating account, and tax account. Now that we have our 4 accounts established, let's look at what are we doing with these accounts now. So these numbers are not set in stone. This is just an example of what you can do with this money. So we're going to run through a scenario here. We're going to go back to that. If I'm making between $0 and $250,000, well, I'm looking at this like this. If a $10,000 commission check comes in, so again, I sell a house, a $10,000 commission check comes in, it hits my operating account, all 10,000. I would want to log into my banking account. And again, keep in mind, you log into one account, you have each account right there listed. And what I'm going to do is I'm going to take 30% and I'm going to leave that $3,000. I'm going to leave that in my operating account. So because if I'm generating between 0 and 250K, I'm probably running somewhere around a 70% profit margin, not factoring in taxes, but probably about 30% of my income would go toward my operating, meaning my cost of marketing, listing photography, signage, all of that stuff, fuel, right? Like putting gas in my car, things of that nature. So 30% stays in my operating account. So a $10,000 check hits my account, 3,000 stays in my operating. I then move 15% of that, which is $1,500, into my tax account. So all I'm doing is clicking in, check comes in, it hits my account, I go in, I transfer funds. So now I'm moving my tax account, $1,500 into my tax account. My owner's compensation, I'm paying myself $5,000 of that, which is 50%, into my owner's comp account. And then my profit right now at 5%. So that would be $500 into my profit account. So that is an example. Now, a couple of things here you might be thinking. Let's just stick on the 0 to 250,000. Again, these numbers can be drastically different depending on your model. Now, people might say 15% taxes seems very low. Why would you only set aside 15% in tax? Well, for the simple reason that once you understand the tax laws and you understand that tax laws were written by wealthy people to not legally pay taxes, and once you understand this and learn how to utilize the tax system to your advantage, keeping in mind that the government incentivizes us through providing affordable housing and creating jobs. So if I go out and purchase a rental property this year, I can do what's called a cost segregation. We still have bonus depreciation, and that chances are that might go back to 100%. I don't know, with Trump being in office now, I'm not sure. We'll see how that's not a political statement. That's just the facts. He's a real estate guy, and he knows how the real estate game is played. So, but through cost segregation study, I could essentially wipe out the bulk of my my tax liabilities just by buying a real estate property each year, an investment property. So we do have trainings on this. Go to networkglobalagents.com. We do have some trainings on the tax strategies. I would also recommend, before you implement any tax strategy, always consult with your tax advisor, your accountant. Just quick disclaimer. But I know that through running my business and utilizing the tax codes, like, keep in mind, thousands of pages of tax code, thousands of pages in tax code. Several hundred are on how to legally pay taxes, how to pay your taxes. The other several thousand pages are on how to legally not pay taxes, how to offset your taxes by doing what the government wants you to do and partnering with the government in order to keep more of your hard-earned income in your pocket. So my rule of thumb is 15%. If you're not feeling comfortable with that, make it 20%, make it 25%, make that number whatever you feel comfortable with. Now, my owner's comp here is 50 and my profit is 5. So let's look at if my income increases. My numbers could look a little bit different. Now, if I'm running a business now, let's say it's generating between $250,000 and $500,000. Well, my operating expense at this point may be higher. So my operating expense may be higher because maybe when I was making 0 to 250, I had a contract to close person that I was paying cost of sale, meaning when that commission came in, I paid them $300 to $500, whatever the price is, and I didn't have a fixed expense of paying them a salary. So my operating expense might be tied to more of a cost of sale, where now at my new production level, maybe I need a full-time admin or 2 or 3 or whatever the case may be. Maybe I have more expense now, like I have invested now. I have a sign runner that goes out and runs my signs. Maybe I have a marketing team, whatever the case may be. So my operating expense would probably go up. So the same scenario, $10,000 comes in, $4,000 stays in, it hits my operating account, $4,000 stays in my operating. 15%, $1,500 to tax, 35%. I'm paying myself less now because my income is higher. All right, so I'm paying myself less from a compensation standpoint, and my profit distribution has gone up. And I think that's the key. You have to pay yourself. The IRS wants to see you pay yourself a salary that's in line with the job you're doing. So if you're generating $500,000, you can't say, well, I'm only going to pay myself 10 grand a year in comp, and I'm going to take the rest in profit distributions. The IRS will not buy that. What they will buy, though, is if you're paying yourself a normal living wage for the job you're doing. Again, the easiest way to keep that in mind is, what would you have to pay somebody to run this business for you? So if I stepped out of Network Global today and I replaced myself, what would I have to pay that person to do what I'm doing? And that's how I factor in what I pay myself from a compensation perspective. And then the rest I leave to profit. So I have 10% profit in this scenario. So I hope that makes sense so far. And if it doesn't, drop questions in, but I hope that's making sense. Now, what I'm doing with my profit account is, with my profit account, my owner's compensation, I'm paying myself that. You can pay yourself monthly. You can pay yourself every 2 weeks. Chances are, if you get linked up with a payroll company, they're going to pay you out every 2 weeks. They're going to take payroll taxes out of that. So that's what you're figuring out, what your salary is that you're living on. But let's look at my profit. Now, in my profit account, and let's use the 500K, the 10% mark here. Let's just say hypothetically I made $50,000 this month, and I put 10% into my account. That's $5,000. So $5,000 is in my profit account. I get to the end of the month and I have $5,000 in my profit account. What I'm doing at that point then is I am doing a 50% profit distribution to however much money is in that profit account that month. So that means if I had $5,000 in my profit account at the end of February, I'm going to give myself a profit distribution. I'm going to write myself a check from my company. I'm going to put in a memo line, profit distribution, and I'm going to write myself a check for 50% of whatever is in the profit account. So I'm going to give myself a $2,500 profit distribution. I'm going to do that every month of the year. Now, people might think, well, what happens if I don't have enough in my operating account to cover my bills in my expenses. Well, we've discovered a new challenge, right? Now, all of a sudden, our business is not running at the level we need it to. So if I find myself with no profit and I can't afford to pay myself comp because everything's going to expenses, I need to start looking at where can I cut expenses? So this is an important rule. And I do an exercise, I call it red light, green light. I use a credit card. So I use credit cards. I like credit cards. I hated credit cards when I didn't have any money because I couldn't afford to pay the bill. But when you have money to pay your credit cards can be a very, very useful tool, especially when it comes to running a business, because you can put everything on your credit card and then you can go look, you pay your credit card, just make sure you pay your statement balance every single month. So that way you don't get dinged with high interest credit, high interest. But if you're disciplined to do that, credit card can be a fantastic tool because I can now go look at my credit card statement and look at all of the expenses I had for the month. And I can begin highlighting what am I paying for that's not generating me a return. Maybe you look and you see, okay, I'm paying for extra Google storage that I don't need. And it's $2.99 a month. And for the last 6 months, we've said, well, it's not a big enough expense to worry about. So we're just going to keep paying for it because at some point in the future, I will need it. If you're not using it, get rid of it. So I go through every month and look at my credit card statement and I start highlighting stuff. What is this expense? Why are we spending this? What is this for? And I'll ask our staff and I'll say, what is this for? Why are we spending this? $14.99 on something we signed up for as a trial. We forgot to cancel it. Now it's dinging us $15 a month. Get rid of it. Right? So look at your statements, look at your bank statements every month, look at your credit card statements every month, and start cutting expenses that you don't absolutely need. Now, what I would say with that is people, if you have staff, maybe you're overstaffed, people would be the last thing I would look to cut. It's also one of our, it can be considered an expense. I look at it as an investment when you have good people. They help you grow your business. But if you have expenses that aren't helping you grow the business, get rid of them. So that's where we're looking at from the standpoint of where are my operating expenses right now, and are they in line with the income I'm generating? Or maybe I'm generating income, I need to go generate more. So maybe I need to go kick it up and make an extra sale a month to increase my income so I can get my business to a profitable standpoint. So I feel that too, we need to think about with this, it's about where are my expenses today? What can I get rid of today? What do I absolutely need to keep to run my business? And also, if I'm running a sales team, if I'm running a team right now, if I took my personal production out of the equation, would that team stand on their own? Would that team be able to support the business? If not, we need to start making some steps and putting some steps in place to look at that and say, what do I need to do to get my business to a point where I could step out of production and I can truly lead the company and this business keeps running? All right, like if you think about Robert Kiyosaki's cash flow quadrant, there's employee, there is self-employed, there's business owner, and there's investor. All right, those are the four little, the quadrant is employee. Now the challenge with employee is you're going to pay the highest taxes and you don't get a ton of benefit from a financial standpoint with the IRS. Like you pay your tax and the government takes their money out before you even see yours, and there's not a whole lot left. As self-employed, now we have a little bit even of a bigger challenge because now we're generating self-employment tax as well. So our tax liabilities actually go up as a self-employed person. Granted, we do have some more upside potential with expenses that we can offset some of our tax liabilities. As a business owner, I now have a business or a system that is running whether I show up or not. So as a business owner, we have a business in place, and that's ultimately where we want to get with that. And we get some substantial, sorry, my phone's going nuts here. We get some substantial tax benefits as well by owning a large business. But the one thing, and so not everybody wants to have this massive business though with hundreds of employees and all this office overhead and liability and that's okay. But what we all can do is become an investor. We can all become an investor and offset the bulk of our tax liabilities by owning real estate. Serves two purposes. One, we're generating positive cash flow and we're getting appreciation on the property. So the property values are increasing every year, and we're offsetting our tax liabilities as well through owning real estate and doing what's called, depreciation. So off subject there. Let me see. I got a couple of questions here. Thank you, Lorenza. What are some smart ways for agents to reinvest their profits for long-term wealth? Yeah, so I mean, simple stuff, right? We'll do another class too on our investing, but even simple things that you can do, like your Roth IRA. Roth IRA, if you're making under, I can't remember the numbers, like 160,000 or something like that. Whatever that, if somebody knows offhand, what's the max ceiling right now for a Roth IRA to invest in? But if you're below that threshold, the Roth IRA, I think, is a fantastic vehicle to invest in. You can put it into an index fund like a Schwab or Vanguard 500 index fund. Those things generate massive returns. I think statistically over the last 10 years, they are 11 or 12% annual return on your money with a very low expense ratio, meaning the fund's not taking a lot of money for you to be invested in it. So some simple things like that. We'll do another thing, but the other one, another training on some of that. So that if you're a higher income earning person, maybe you can defer your income through a simplified employee pension, a SEP IRA. You can really max that thing out, 60,000+ now. You can put into that every year. Now, keep in mind that's offsetting your income tax today. So the difference between the Roth and that, one, the amount of money you can put into it is substantially lower with the Roth. The thing I like about the Roth, though, is that you're putting money into it today and paying tax on that money today, but it's compounding and growing tax-free. So when you start to do just withdrawals in the future, you're not going to pay income tax on all that money you've generated. With the SEP IRA, you're deferring your tax today. So if I made $100,000 this year and I put 60 grand into my SEP, or whatever the case may be, there's parameters there, but let's just use that for conversation's sake. I would not pay taxes on that 60,000 I put into it. I would only pay taxes on the remaining 40. And then when I start to withdraw money in the future, though, I would be taxed on that money. But you can let your money compound basically compound pre-tax, so that way you can generate a larger nest egg. So we'll do a training on that. It's a really good question. But with this, and then also investing in real estate. We're in the real estate business. I firmly believe we should all own real estate. And what's nice about real estate too, like I have investment properties, a pretty good number of them. And with my profit first model that I use for my investment properties, I only have my operating's like 25%. My tax is 15%. My compensation is 25%. And then my profit is 35% on that. So my numbers are different than my real estate business, my sales business. They are very, very profitable. And if you run them right, you can have a pretty low expense ratio. And then let's get back to the profit real quick. Profit distribution monthly, you're going to profit 50% of what is in that profit account. Now your tax account, here's the nice thing. Your tax account, let's say once your tax bill comes due, you pay your taxes through the money in your tax account and there's money left over. Let's say you have an extra $5,000 in that tax account because your taxes were lower than you anticipated. Well, now you get to pay yourself that all of it in the form of a profit distribution. So keep that in mind. This to me is a very easy way to start getting a better handle on your finances. So what do? Every Friday, I go in and look how much money came in this week. And let's just say hypothetically, 10 grand came in this week, right? I go in and I move my numbers so it all hits my operating account. I go in every Friday and move my numbers where they need to go. And so I just simply go to transfer, you can transfer in your bank, go online, you hit transfer, and you just transfer the funds into each account. And then at the end of the month, I look and see how much profit is in there. Am I doing okay from an operating perspective? Yes, everything looks good. Everything's good. I got enough fund reserves in there. Everything's good with an operating perspective. I have $20,000 in my profit account right now. It's the end of the month. I distribute $10,000 to myself in the form of an owner profit. Now, what's cool about this is when you do it this way, you're going to start to want and care about your profits more. They say that money follows attention. So when we focus on sales, we generate more sales generally. We generate more income. When we focus on profit, we focus now more on how much of that income are we keeping. And it's much easier to make better business decisions when we don't have a ton of money. When my operating account has a lower balance in it than it would if just all of my money was sitting in the operating account, if I didn't break it up into 4 accounts, let's just say I had 100 grand, right, sitting in my operating, and I haven't pulled anything out for taxes, for profit, for owner's comp. I feel better about spending money because there's more money in that account. But when I look at my operating, there's 30 grand in there, and then I've got money allocated to my taxes. I'm paying myself a wage, and then I've got my profit account. Well, now I become a much more disciplined owner because I know there's not that much in my owner account or my operating account, and I want to be able to pay myself some profit here at the end of the month. So now all of a sudden I become much more calculated on things I'm spending my money on. I start thinking more about, do I really need that in my business? Do I need that, and will it help us grow, or is it an unnecessary expense that we don't need to spend money on right now? And so what I find with that is that the less money you have in your accounts, the more strict you'll be in not spending. And it just goes back to what I was talking about earlier. When money's flowing in, it's easy to flow right back out. I see it with agents all the time. Like I've seen agents that all of a sudden their income goes up and their lifestyle increases immediately. They go out and spend 10 grand on something they didn't need. And it was like the 10 grand they just made, not thinking for the future. And so we want to make sure that as our income increases, of course, we all like nice things, right? Even the people that say we don't need this or that, or they don't like nice things, they do. You know, staying at a Four Seasons is much better than staying at a travel lodge. I've stayed at both. I can tell you from firsthand experience, it's much better. Four Seasons, right? It just is, right? Taking nicer vacations and being able to spend money on things that are just nicer, it helps. I was talking to a buddy of mine the other day. He runs one of the top microbreweries in the country, and he's having some personal stuff going on. And we talked about how money doesn't necessarily make you happy, because if you're not happy without money, you won't be happy with it. But what money does do is it's a tool that takes the pressure of life off to some extent. What I mean by that is the bulk of people in our society have financial stress that they live with every single day. And then maybe you're there now, maybe you've been there in the past. I certainly have been there in the past, where you wake up with financial debt, you think about it all day, you can't sleep at night thinking about it, debt collectors calling you left and right. So having money, there's nothing wrong with making a lot of money and having a lot of money. It takes the financial pressure of life off to a pretty large degree, in my opinion. What I would also say, when people say money changes people, money does not change people, money reveals people. If you're a good person without money, you're going to be an even better person with it. If you're a bad person without money, probably going to be a bad person with it. So money doesn't change people, it simply reveals them. So my advice to you would be, don't be afraid to go out and make as much money as you can. Right? The more money you have, you can help people. If you ever have too much, you can give it away, right? And help a lot of people. So I hope this was helpful. I hope this made sense. I'm not seeing many questions in here, but hopefully this makes sense from the standpoint of how we operate our accounts here and how we allocate. Now, let's say right now your expenses are very high and there's not enough for profit. What I would do is still set your profit account up and put what your target allocation amount is, because that's also what I do, something I didn't mention. In my account, whatever my numbers are. So like in my investment account, 35% profit. So what I do is I put profit, I name that account profit, and I put 35% next to it, because I know that's how much I'm putting into that. And then I have tax, 15% next to it. I know that's how much I'm putting into that. I have compensation, owner's comp, 25%. I have profit, whatever, or whatever the operating, 25%. You put the number right next to it. And let's say right now, you can't afford to put anything in there from profit because we have a lot of high expenses. I would put what your target profit allocation percent is, so you can look at that every time you move money. It's okay, I need to get to 5%. Where else can I cut expenses? What I would also do in the beginning, if you have an expense issue right now, I would look at your money every week. I find that logging into your checking accounts, your bank accounts, your savings accounts, looking at your money at least weekly, if not daily, will help a lot. I was a guy that used to be terrified to go to the ATM and pull $20 out because chances were pretty high I didn't have 20 bucks in there. I hid from the situation that I didn't have money. Once I started to own the fact that I need to go increase my income, make money, and start taking responsibility for my financial situation, that's when my money started to grow. So look at your accounts often, know how much money you have in them, look at your expenses often, get rid of things. Don't say, well, it's only this or it's only that. Maybe right now you're paying for Netflix. From a personal perspective, I do this as well too. I look at our horrific amount of Amazon purchases we buy and we say, do we really need this? Because Amazon's a very easy way to spend money. It's super simple. Click a button, it shows up today. or tomorrow. But look at your expenses often, cut expenses you don't need. Even if it's only $19 or $9 or $2, get rid of it if you're not using it. And that becomes a way that you can start to kick more profit into your business. Okay, question. Can you review the 4 accounts needed real quick? Also, what happens if you can't make your personal payroll check 1 month? Yeah, so the 4 accounts: profit, owner's compensation, taxes, and operating. So right here on the screen. Profit account, compensation, taxes, operating. If you can't make your personal payroll check 1 month, you call, you don't pay it. All right. But the goal here is you just don't pay yourself. The goal here, though, is to get to a point where your expenses are in line with the income you're making. And so, like for myself, I'm set up with a payroll company. They pay me every 2 weeks. And so that's just the way it's set up. In the past, I have had that happen, Bobby. It's a good question. I have had that happen where I couldn't afford to pay myself. I could barely afford to pay staff. And so I would reach out to my payroll company and say, don't pay me this week. Don't pay me this month. And I would still pay my employees, of course, but that can happen. But that also ties into, I need to get a better handle on my expenses, and I need to get a better handle on the money coming in. So it can happen, and it does happen, unfortunately, but we want to get it to a point where the owner's compensation now is pretty minimal compared to the amount of income coming in. And then our expenses are controlled enough to where we're not spending like crazy and to where we're comfortable. So once you start having pretty good reserves in these accounts too, you're going to feel a lot better about it. Once you know you've got 6 months of a cushion here, or a year, or 5 years, or 10 years, or 30 years, whatever the case may be, you'll feel better about it. So that's a really good question. It can happen. But yeah, there might be months where you can't pay yourself. But then too, we need to look at, what are the activities I'm doing, and why is my income coming in slow right now? Why is my revenue slowed down? Maybe I've taken my foot off the gas because it's the holidays. Maybe I haven't been doing the things that I need to be doing in order to generate business. Maybe in the past I was doing 2 open houses a week. Now I'm not doing any. I probably need to get back and doing that. So good question, but those are the accounts: profit account, owner's compensation, tax account, and operating account. So hopefully this made sense. Hopefully you start doing it. Again, you can go to your bank, set these up very easily. Most banks have a minimum amount that you have to put in. It's usually not that much. So you can go in and set maybe $250 in each account. You get it set up. And then again, have your operating account be the account that your commissions go into. Then start moving your money weekly from there. And so if you have questions on this throughout the day, throughout the week, maybe you're watching this later tonight, tomorrow, next week on a recording, feel free to reach out and call anytime. That is all we have for today, I believe. Yes, it is. If you are new to Network Global, jump on for orientation today at 11. We have agent orientation today at 11 a.m. So make sure you jump on that. A link will be sent out. And other than that, that's all we've got for today. Hope you all have a great day. If you need anything, we'll talk soon. Thanks, everybody.